Hello everyone. The month of October saw the first foreign outflow from domestic debt since India's inclusion in bond indices, with foreign investors offloading around 4,700 crores. This was the second net outflow this year following a bigger sell-off in month of April. This was largely due to reallocations towards safe haven assets due to uncertainty around the US election outcome. The outcome of US election has led market to price in the prospect of higher fiscal deficits, higher inflation expectations, which has driven up the US yields. The US 10-year yield has already seen a near a 60 basis point jump and is hovering around 4.3%. In nearly the same period, India's sovereign yield curve has seen a 10 basis point movement across the maturity segments. This upward shift in the sovereign yield curve in India is also the market response to some incremental change in the macro background. First, the expectation of the higher inflation in month of October, as faster disinflation in vegetable prices is still some time away. Secondly, we have seen some improvement in the high frequency growth numbers. And finally, volatility in currency market has returned. INR USD pair has depreciated to an all-time low in response to the continuous FPI outflows and US election outcome. In coming days, there will be volatility in domestic markets as market would look out for change in inflation expectation and development in fiscal policy in US post the regime change. The impact of these two factors would also mean that a term premium in US would expand. For emerging market, this is a tight situation, as expectation of higher terminal rates in US and tighter global financial conditions would create FX-related risk. However, India is well placed in comparison to peers due to its domestic demand-driven economy, higher growth and higher foreign currency reserves. The growth forecast by RBI is still not revised downwards. The volatile food inflation can ease with better agriculture output ahead, as we have seen surplus rains this season. Fed's 75 basis cut has widened the policy rate differential with India, and additional 25 bips cut this year will create more headroom. However, the focus of the policymakers for now will shift to manage external market risk, warranting a delay in rate cuts, as other macro risks in form of growth and inflation are very much in control. Thanks.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.